How big is too big? It is a question that echoes through the halls of finance, whispered among investors and shouted by analysts. In 2014, the United States stock market seemed immense. Its total value or market capitalization stood at a staggering $26 trillion. That number on its own was a testament to the sheer scale and power of American enterprise. But numbers do not exist in a vacuum, they tell stories. 10 years later, as we stand in 2024, that same market has swelled to over $50 trillion. This dramatic growth forces us to ask an even more pressing question. Have we witnessed a decade of incredible progress, or are we standing on the precipice of a market that has become dangerously overvalued? To begin to answer this, we must look beyond the headline figures. We need to understand what these trillions of dollars truly represent. They are not just abstract numbers on a screen. They symbolize the collective value investors place on the future earnings of thousands of publicly traded companies. This value is a reflection of confidence, of innovation, and of the flow of capital from around the globe. We will journey back to 2014, then fast forward to today to see what has changed and what has stayed the same. To understand the market's size, we must first grasp a fundamental concept. That concept is market capitalization, often shortened to market cap. It is the total dollar value of a company's outstanding shares of stock. The calculation itself is beautifully simple. You take the current price of a single share and multiply it by the total number of shares the company has issued. For instance, imagine a company, let's call it Future Tech, has 1 billion shares trading at $200. Its market capitalization would be $200 billion. It is a simple formula for a powerful idea, a real-time measure of a company's public worth. This metric is how we categorize the players in the market: large cap, mid cap, small cap. Large cap companies are the giants, valued in the tens, hundreds of billions, and now even trillions. When we talk about the total stock market, we are adding up the market caps of all publicly listed companies. However, market cap is not the same as a country's economy. GDP is a flow, output over a year. Market cap is stock the size of the reservoir. They are related but distinct, and their divergence lies at the heart of overvaluation debates. In 2014, the United States market was the undisputed leader, its $26 trillion valuation far surpassing any other nation. Japan held a strong second place. China's Shanghai and Shenzhen were rapidly ascending, signaling growing economic might. Established hubs like the United Kingdom and developed markets like Canada played significant roles. Each market was a unique ecosystem shaped by its strengths and rules. Fast forward to 2024, the United States has not only maintained its lead, but extended it with its value more than doubling. Unprecedented technology growth with global reach fueled this dominance. China solidified the number 2 spot, though with more volatility and regulatory headwinds. Japan and the UK remain major players, but growth has been more modest. Global value is increasingly concentrated in the United States. The gravitational pull of American tech attracts a disproportionate share of capital. Portfolios are more tightly linked to a handful of US companies than ever. Different countries' markets mirror their economic characters, resources, brands and finance, or technology and communications. How do we know if a market is getting too hot? A simple, powerful metric compares total market capitalization to gross domestic product, GDP. Popularized by Warren Buffett, he called it the best single measure of where valuations stand. It pits the market's reservoir against the economy's river of output. At 100%, market equals 1 year of GDP. In 2014, market cap was around 26 trillion, GDP about 17.2, roughly 151%. Historically, readings above 100% have signaled potential overvaluation. By 2024, market cap surged past 50 trillion. GDP reached around 28, pushing the ratio near 180%. A market that seemed expensive then looks even more stretched now, igniting fierce debate. Some see a clear warning. High readings often preceded major downturns. Others argue global earnings and years of low rates justify a higher new normal. The truth likely lies somewhere in between these extremes. What matters is context, how these levels relate to the structure of wealth and the real economy that supports it. When we talk about a $50 trillion stock market, it is natural to ask who owns all of it. The answer in large part is ordinary households. The flow of funds accounts give us a look inside the collective balance sheet of the American people. Back in 2014, households and non-profits held about $69.1 trillion in financial assets, from cash and money market funds to bonds and corporate stocks. It is the accumulated savings of millions funding retirement, education, and life goals. A major share was in equities, with about 13.6 trillion directly held, and even more held indirectly via mutual funds and pensions. When you contribute to a 401k or a pension, that money is often invested in the market on your behalf. This ties household well-being to market fortunes, even for those who never trade a single stock. By 2024, the scale of these holdings had grown immensely, mirroring the market's expansion. Total household financial assets ballooned to over $120 trillion. The value of equity holdings directly and indirectly skyrocketed, with equities and mutual funds well over $40 trillion combined. Seeing accounts grow can lift confidence and spending, the wealth effect in action. But greater exposure means greater vulnerability to market swings. A similar percentage drop now cuts deeper because the base is so much larger. A soaring market creates wealth on the way up and amplifies the pain on the way down, especially for those near or in retirement with less time to recover. Wealth is a two-sided coin. To gauge financial health, we must weigh assets against liabilities. In 2014, household and non-profit liabilities were about $14.2 trillion, mostly mortgages, followed by consumer credit like credit cards and auto loans. When assets grow faster than debts, net worth rises. Assets minus liabilities equals net worth. In 2014, net worth stood near $84.1 trillion, a post-crisis recovery. For many families, home equity and retirement accounts formed the foundation. By 2024, liabilities climbed over 20 trillion, but asset values exploded, fueled by stocks and rising home prices. Total assets exceeded 160 trillion, pushing net worth past 140 trillion, an extraordinary decade of wealth creation. A fantastic story of prosperity and increased dependence on asset prices rather than saved wages. Its foundation rests more in financial valuation than in the real economy's production, and wealth built on valuation can vanish quickly if sentiment turns. So, after a decade of unprecedented growth, is the market overvalued? The numbers provide no simple yes or no answer. Instead, they offer a framework for intelligent thinking. With the Buffett Indicator near historic highs, a warning light is flashing. Expectations look exceptionally optimistic, priced for perfection. A slowdown or sentiment shift could prompt painful repricing. Yet global business models and US tech's dominance may justify higher valuations. Retirement accounts create a more stable base of ownership. Do not panic, be prudent, diversify across assets and geographies. Match risk to your time horizon. Near retirement, consider dialing down equity exposure. Don't try to time the market. Understand context and respect the risk. Build a resilient plan for cycles, high valuations, and an uncertain future.